Welcome to our comprehensive analyst report presentation, titled The Hong Kong Kingmaker. Today, we will conduct a deep dive into HSBC's strategic master plan for Asian dominance. Given the bank's unique positioning and recent bold maneuvers, we are initiating coverage with an outperform rating and a price target of $88. To begin with the executive summary, HSBC currently stands as the incumbent to beat. As the global economic center of gravity shifts toward Asia and trade flows increasingly diversify away from the dollar, HSBC has positioned itself at the nexus of this transformation. With record profits and a $1 trillion deposit base, the bank is not merely reacting to market changes. It is actively engineering a future defined by Greater China connectivity and financial firepower. Turning to Chapter 1, we examine the sheer scale of this financial powerhouse. The 2025 fiscal year was characterized by record-breaking metrics, including a profit before tax of $36.6 billion and group revenue exceeding $71 billion. Perhaps most impressively, the bank's deposit base grew to $1.8 trillion, creating a formidable fortress of capital while allowing for a 14% dividend hike for shareholders. Analyzing this $36 billion profit machine further, these results represent a generational peak for the institution. The 7% year-on-year growth in pre-tax profit was bolstered by a significant Q4 surge that outperformed market expectations. This robust earnings trajectory provides the necessary momentum for the bank to fund its ambitious strategic pivots while maintaining a generous capital return policy of 75 cents per share. In Chapter 2, we explore the de-dollarization engine. HSBC's most valuable strategic asset is its global transaction banking franchise. As trade increasingly utilizes the renminbi corridor, HSBC's geographic footprint creates a structural advantage that competitors find nearly impossible to replicate. This is evidenced by the $80 billion in net new invested assets attracted in 2025, with a substantial portion flowing directly into Asia. This connectivity moat represents an unfair advantage in the marketplace. By operating across more than 60 markets, HSBC simplifies cross-border complexity for multinationals, resulting in high switching costs and predictable fee income. This moat is further reinforced by the massive migration of private wealth into Asian markets, where HSBC's Hong Kong and Singapore platforms serve as the preeminent gateways for ultra-high net worth individuals. Chapter 3 focuses on the $13.7 billion power move, the full privatization of Hang Seng Bank. This represents HSBC's boldest strategic consolidation in a generation. By integrating these two institutions, management aims to unlock $900 million in synergies by 2028 and has committed to a return on tangible equity target of 17% through 2028. However, dominance comes at a price. The acquisition required a $13.7 billion spend, resulting in a temporary 110 basis point hit to the CET1 capital ratio and a pause in share buyback. Despite this short-term pressure, management's confidence is clear. They view this as a multi-year play where the immediate capital impact is the deliberate cost of securing long-term market leadership in Greater China. Taking a deeper look at the $900 million synergy target, the value will be realized through three primary channels. First, revenue synergies will be gained by cross-selling global products to Hang Seng's retail base. Second, cost rationalization will eliminate duplicate infrastructures. Finally, capital efficiency will be improved by internalizing Hang Seng's capital generation, allowing for more agile redeployment into high-growth initiatives. In Chapter 4, we must address the hidden risk. No master plan is without its vulnerabilities. HSBC faces concentrated credit risk in Hong Kong's commercial real estate sector, which is currently under structural pressure. Furthermore, a significant red flag is the spike in the debt-to-equity ratio, which surged from 1.3x to 2.8x in 2025, increasing the bank's sensitivity to macroeconomic shock. Focusing specifically on the real estate overhang, while the $1.9 billion in credit-impaired exposure is currently manageable, it is not trivial. High vacancy rates in the office sector are compressing landlord cash flows. While management is actively monitoring this exposure, any further deterioration in property values or a slowdown in mainland Chinese growth could necessitate additional provisioning in the coming years. The leverage spike is another critical variable for investors. The doubling of the debt-to-equity ratio is a direct result of the Hang Seng acquisition financing. While higher leverage can magnify returns in a stable environment, it also amplifies downside risks during regional credit events or interest rate volatility. Consequently, leverage sensitivity will be a key metric to monitor in the 2026 result. Chapter 5 shifts focus to the AI efficiency play. Parallel to its geographic pivot, HSBC is transforming into a technology-first institution. Through a reorganization that includes a 15% reduction in managing director positions and the deployment of AI across global operations, the bank aims to achieve $1.5 billion in annualized cost savings to protect its margins. The simplification roadmap illustrates that this is not merely a cost-cutting exercise, but a structural redesign. By retiring legacy applications and utilizing AI for compliance and risk monitoring, HSBC is turning a traditional cost center into a competitive weapon. These savings are being strategically reinvested into Asian growth and returned to shareholders, signaling a leaner and faster execution model. Synthesizing these strategies, the master plan rests on three pillars: maintaining dominance in global transaction banking, consolidating the Greater China franchise through the Hang Seng deal, and leveraging AI-powered efficiency. Together, these pillars ensure that HSBC remains the essential conduit for global trade while maintaining profitability as interest rate tailwinds normalize. Regarding the valuation framework, management has been unusually explicit in committing to a 17% or better return on tangible equity through 2028. This commitment serves as the formal benchmark for executive compensation. Success depends on the timely realization of Hang Seng synergies, the success of AI efficiency programs, and the stabilization of the Hong Kong real estate portfolio. We must also consider the bull and bear cases. The primary swing factors include the trajectory of the Hong Kong property market and the pace of global trade de-dollarization. Our $88 price target represents a probability-weighted outcome that assumes controlled credit deterioration and continued momentum in Asian wealth flows. Looking at the competitive landscape, we believe no single peer can replicate HSBC's integrated model. Standard Chartered lacks the same scale in Greater China, Citigroup is retreating from Asian retail, and Chinese state banks face geopolitical constraints in Western market. HSBC uniquely occupies the bridge between East and West, a position that the Hang Seng deal only serves to deepen. For investors, the key checklist for the coming year includes monitoring real estate provisioning, the normalization of leverage, and the timing of buyback resumptions. On the upside, tracking Asian wealth flows, renminbi trade volumes, and AI-driven cost savings will provide real-time indicators of the bank's execution against its long-term strategic target. In conclusion, HSBC is the incumbent to beat in the new era of Asian-led finance. While the Hang Seng privatization is an expensive and leveraged bet, it is a deliberate move to secure a generational advantage. With a clear efficiency program and a dominant position in global trade corridors, we reiterate our outperform rating and $88 price target.